Well, the Fed didn't deliver the yield curve control that some in the market were looking for, but they gave us the next best thing. Pretty firm intentions to be keeping the Fed funds rate on the floor for the next 2.5 years, a rate of QE purchases that pre-coronavirus crisis we would have thought was extraordinary. So it's clearly the liquidity spigots are still turned fully on from the Fed and looking at supporting market pricing with the follow-through to economic activity, hopefully to come.
We've just seen the largest ever 50-day rally in the S&P 500 and the Russell 2000, and we know what's going on with the Nasdaq here. And yet, when Jay Powell was asked about the Fed's responsibility in relation to inflating asset prices, he basically dodged the question and said we're focused on employment, not asset prices. What do you think that means then in terms of the Fed's actions going forward to manage both credit expansion and speculation in financial assets? How's this going to end, Chris?
Yeah, the change in tone here is pretty extraordinary. So if we think back to the last cycle, we had members of the FOMC talking about feral hogs in the high-yield market being something that was of concern because of tightening spreads. There's absolutely no hint of that from the Powell-led Fed. And I think it's a sort of broader global point. The central banks and reserve managers have now bought up assets worth around 30% of global GDP. So their focus is very, very much on inflation mandates, and in the Fed's case, their dual mandate. It's not on kind of concerns around financial conditions that may be too loose. I mean, that is a problem to be addressed another day. I don't think there is a clear strategy for how to get out of these policies yet. But as I say, that's a problem for another day as far as they're concerned when you're looking at the kind of unemployment rate that we're seeing printed.